So if we look at residential borrower qualification, really what we're asking here is, how much money can I get? Right? Said a slightly more eloquent way, what amount of loan funds can a purchaser receive from a lender to purchase property? How much money can I borrow? Well, that's the question, and the answer is, well, it depends. Depends on a couple of things. Depends on the borrower's income, and it also depends on the value of the property. So we have to look at both the borrower's income and the value of the property to figure out how much money a lender is willing to advance on a specific piece of property to a specific borrower. Now, what lenders are largely concerned with is risk. Well, lenders are concerned with making money, but they're only concerned with making money up to the point they don't exceed any risk tolerances they may have. So they're concerned with risk. So how do they manage risk? Well, they manage risk by lots of different rules and policies. The first kind of risk that they're concerned with is the risk of default. So lenders have to deal with default risk. And default risk is the risk the borrower's income is not sufficient to cover the mortgage payments. So the borrower's income is not sufficient either initially to qualify for a certain amount of mortgage funds, or that at some point down the road they're not going to be able to pay the mortgage. So they want to make sure your income is high enough now and it's sustainable in a reasonably long period of time, over the term anyway, to make sure that you can pay. So lenders are concerned with income. The way that they deal with income is with something called the gross debt service ratio. So we'll look at this ratio in detail in a few minutes, but this is the ratio they use as a test to see how much of a mortgage loan your income will support. That's what it's about. So default risk is one kind of risk that lender is concerned with. The other kind of risk that lenders are concerned about is capital risk. And capital risk has to do with the capital value of the property. So this is the risk that the property value won't fall below the amount loaned against it. If that occurs, the lender risks losing some of their security. So the value of the property is lower than the amount loaned against it, sometimes called being underwater, which is not very good if you're a borrower. So a lender doesn't want that situation. So they need to manage that as well. So they manage that risk by using something called the loan-to-value ratio. And they don't want lenders to exceed a certain percent. So loan up to a certain percentage of the value of the property, but they won't exceed that. So we'll look at both of those tests or constraints and see exactly how they work. Let's look at the gross debt service ratio first. So the gross debt service ratio, often abbreviated GDSR, so we see GDSR, that means gross debt service ratio. So the gross debt service ratio is a ratio, and a ratio simply means there's something relative to something else, so something compared to versus something else. In this case, the gross debt service ratio is equal to the principal that you would be paying on a mortgage plus the interest. And of course, principal plus interest is just your payment. So the gross debt service ratio is equal to your mortgage payment plus property taxes divided by your gross income. So we can abbreviate this a little bit more and simply say the gross debt service ratio is equal to your payment plus property taxes divided by gross income. So as a ratio, it's simply a ratio of money that goes out, so you have to make mortgage payments, you have to make property tax payments, relative to money that comes in, which is your gross income. So it's just money out to money in. That's what the ratio is. Now this is the simplest form of this equation. You might see other terms or components added to this as well. The idea being that if you're going to purchase real estate, you're going to, of course, have to borrow money to make mortgage payments. If you own real estate, you're going to have to pay property taxes, right? Can't avoid that, at least not very easily. Well, what else might you have to pay? Well, you might see other components added to this equation. You might see an amount for heat, cooling. Certainly in some parts of the country, the cost to heat and cool is a substantial part of owning real estate. So if it's an inextricable cost to own real estate, it makes some sense to include it in these kinds of calculations. You can't buy a house, pay your property taxes, and not heat it, at least not in most places. Sometimes you might also see half of the maintenance payments included if it's a strata property. So for condos, you have strata payments. And if you look at some stratas, some of the payments, the maintenance payments, aren't just a couple $100 anymore. They're $500, $600, $800, $1,200, $1,300. Really high cost. So that's a cost that's inextricably associated with owning real estate, so it may be included as well. In our examples, we'll look at the most simplest forms, just for illustration. Now, what we typically want to find, what we typically want this equation, this ratio to do for us, is to find the payment. Because that payment term in that equation represents the maximum payment the borrower can afford to make based on their gross income, based on the property taxes, and based on the gross debt service ratio that's set. So if we do a little bit of algebra and change this equation around a bit, we can manipulate this equation into this form. So this says the payment, so this is your mortgage payment, the maximum mortgage payment you can afford is equal to the gross debt service ratio multiplied by gross income minus property taxes. So that's the simplest form of this equation. Now the gross debt service ratio as a number is generally around 32%. So you may have heard a rule of thumb about a third of your income goes toward housing. Well, that's where it comes from. So about 32% of your gross income minus the property taxes. And if you had a question that also gave you an amount for heat, you'd subtract heat or half the maintenance payments, whatever they give you in the question, subtract everything. That gives you the maximum payment. Okay. So getting the maximum payment gets us partway toward figuring out the maximum loan. So what we need to do next is say, well, hey, how do we determine the maximum loan based on the maximum payment? Well, two simple steps. The gross debt service ratio equation gives us the maximum payment. We looked at that a moment ago. The present value of the maximum payment gives us our maximum loan. So all we do to find the maximum loan is just discount the maximum payments you can afford over the time frame and at the interest rate you're dealing with. And the present value of your maximum payments is the maximum loan. So all these borrower qualification questions in this case are just present value questions. And we'll do some examples. Now this was the first constraint or test, this gross debt service ratio constraint that had to do with default risk, had to do with borrower's income. Let's look at the other constraint as well. The other constraint had to do with capital risk. That has to do, that's determined by using loan-to-value ratio. So let's look at that next. So loan-to-value ratio. So this is another ratio. Again, it's just something relative to something else. So it's the loan relative to the value of the property. So the ratio of the maximum loan amount to the lending value. So that's what the ratio is. And if we just put some numbers to this and show a simple example, it's relatively easy to illustrate. Let's suppose that the maximum loan for a property had been determined, and the maximum loan is $280,000. The lending value of the property is determined to be $350,000. So if we divide these two, the loan to the value, if we divide these two, we get 0.8 or 80%. So we could say the loan to value ratio here was 80%. So that's what the loan to value means. Now when we talk about value, we're talking about lending value, which is not what the property is necessarily listed for. It's not what you think it should sell for. It's not what the homeowner thinks it should sell for. It's not the value that was determined a couple of years ago by an appraiser. The lending value is the value that the bank is comfortable with believing that that's what your house is worth. So lenders typically require some kind of valuation on property before they'll lend against it. Sometimes those valuations are just done using computer models. It can be done very quickly. CMHC has a model, LandCorp has a model. Those can be done very quickly and inexpensively. They simply look at assessment data and sale data in the area for similar homes. All that information goes into a black box. Out comes the value of your home. And that's probably close enough or good enough value for most banks in most situations where the markets are buoyant, there's lots of buyers, there's lots of sellers, prices are rising. Of course, determining lending value in markets where they're depressed, there haven't been many sales in a long time, or the property that's being appraised is very unique, sometimes lending value is difficult to determine. Might require a more thorough or comprehensive, full narrative appraisal report. The appraiser goes out and looks at everything and measures everything and produces a 30 or 40-page document with the last page saying it's worth $1 million. So those values are lending value. So it's the value that the bank is comfortable with. So they're usually in the driver's seat in terms of hiring the appraiser or determining the value. Okay. So if we looked at this equation and think, well, how can this be useful to us? Well, what numbers do we typically know? Well, we want to find out what the lending value is. We can hire an appraiser, or the bank can hire an appraiser. That's relatively easy to determine. The ratio itself is somewhat fixed, so we typically know what the ratio is, and we'll talk about that in a moment. What we don't know is the loan amount. So if we looked at this and changed this equation around a little bit, and we manipulated it such that we had the loan-to-value ratio on one side of the equal sign and lending value on one side of the equal sign, the loan-to-value ratio multiplied by the lending value would give us the maximum loan. And so this is how we'll use the loan-to-value ratio to figure out what the maximum loan is. We use this example. Let's put these numbers together. So loan-to-value ratio of 0.8 or 80% is determined by the lender. They know that. Lending value they can determine. That gives us a maximum loan of $280,000. So a simple calculation, but that's how we use loan-to-value ratio to determine the most we're going to loan, the most the lender will loan against the property based on the property's value. Now, a couple other things about loan-to-value ratio. The loan-to-value ratio is set by statute for federally regulated financial institutions at 80%. So banks can loan up to 80% of the value of a property. As some of you may recall, for many years that was 75%, so it was lower. And the federal government raised that to 80%, likely as a desire, as a goal to allow people to borrow more money, buy more houses, invest more in the economy, and all those sorts of good things that happen as a result of a buoyant housing economy. So it's at 80%. Now, you can go above 80%, but if you go above 80%, you need insurance. So 80% isn't a hard cap, it's a soft cap. You can go above, but you need loan insurance. And CMHC is the main provider of loan insurance in Canada. The way the loan insurance works is that insurance is for the lender. It's not for the borrower. So the borrower pays the insurance premium. The borrower pays the fee for the benefit of the lender. The lender is willing to loan more. They're going to take on more risk. They're going to require insurance. So the insurance premiums increase as the loan-to-value ratio increases. So for example, if you want to go from 80 to 85%, the loan-to-value ratio, the fee, the insurance cost is 1.8% of the loan amount. If you want to go to 95%, it's 3.15% of the loan amount. So the more you borrow, the greater the risk there is to the lender, because the property value has to now only fall by, say, 5%, more than 5%, before they could possibly lose some of their security. So the more risk, the more insurance is needed, the higher the premiums are. Just like car insurance. If you're a bad risk, you pay higher premiums, right? The same thing with mortgage loan insurance. Now, insurance premiums, like all fees that we've talked about, have what effect on the cost of borrowing? Well, they've raised the cost of borrowing. So if you've got to pay fees, you've got to borrow more money to pay fees, all those raise the cost of borrowing. So it becomes more and more expensive for the consumer to borrow more money. But it's about insurance, so the lender is covered. So in the event of default, and there's a potential loss, the lender could be compensated, not the borrower. So it's insurance for the lender. And that might be different than any, some of you may have income replacement insurance in your workplace, particularly if you're in a high-risk occupation. If you're unable to work for a period of time, the insurance kicks in and pays your mortgage payment. Now that's different insurance from this. This is not what we're talking about here. Okay. So that's loan-to-value ratio. So let's look at an example. We'll use the loan-to-value ratio calculation to determine the maximum loan based on the loan-to-value ratio. We'll also use the gross debt service ratio to determine the maximum loan based on income. So we'll end up with two maximums. And then what we do is we choose the lower of the two, or the most constraining of the two. So we'll choose the lower of those two maximums. Let's look at an example and work through one. Okay. So lots of facts here, so we'll go through this carefully. So in this example, it says, you'd like to purchase a house in Langley, BC. You have a gross income of $94,000. The bank applies a gross debt service ratio of 30%. The interest rate on the mortgage that you're trying to organize is J12 equals 4.75%. Those payments will be amortized over 25 years, and they'll be monthly. Property taxes, are $2,700 per year. The loan-to-value ratio is 0.8, or 80%. And the property is valued at $555,000. The question is, what is the maximum loan this person can receive under both loan constraints? Okay. So we'll go through and we'll look at this question. We'll look at both loan constraints, loan-to-value ratio, and we'll look at gross debt service ratio. We'll determine two maximums, and then we'll choose the lower or the most constraining of the two constraints. So I've summarized all the information here. GDSR, interest rate, amortization period, or monthly payments, property taxes, which are per year, loan-to-value ratio, and the value of the property. Now, when you calculate the maximum loans, it doesn't really matter if you do the loan-to-value ratio first or the gross debt service ratio constraint first. We'll do both. It doesn't really matter. In this case, I'll do the loan-to-value ratio first. It's the simplest calculation, so let's start there. So loan-to-value ratio, we know that the maximum loan based on the loan-to-value ratio is going to be the loan-to-value ratio itself, which is 0.8, multiplied by the lending value. And the value that we're given in the question is $555,000, so of course we can assume that's the lending value. If you ever got a question that gave you several different values of the house, you would simply look for the value where it said lending value, or it said the bank believes the value of the house to be this. So it's about lending value, it's about the value the lender thinks is appropriate. So loan-to-value ratio is fairly easy calculation here. So it's $555,000, which is the lending value, multiplied by 0.8 or 80%, and that gives us $444,000. So that's our first maximum. So based on the value of the property, that's it, $444,000. That's how much the lender is willing to advance with conventional financing, no loan insurance. So that's the first constraint. Second constraint, of course, is the gross debt service ratio constraint. So let's look at that. Well, if you recall, the gross debt service ratio, the equation was the payment, which was a maximum payment, is equal to the gross debt service ratio itself, multiplied by the gross income of the individual or individuals, minus property taxes. So the gross debt service ratio is given as 30% or 0.3. The income is also given. I think we had it on the previous slide, which was $94,000, I believe. Yeah, $94,000 was the gross income. And that's gross income. So that's not net income, that's gross income. So gross income was $94,000 in the question. And the taxes were $2,700 per year. Something else to keep in mind in this gross debt service ratio equation, all the terms that we'll use here are annual amounts. So there'll be annual property taxes and annual gross income. So if you had a question that gave you property taxes per month, multiply them by 12, get the annual amount and use that. If they said the borrower's income was $4,000 a month, well, multiply by 12, get the annual amount. So let's just fill in the blanks here. Gross debt service ratio is 30% or 0.3. The gross income of the borrower from the previous slide is $94,000. And the property taxes are $2,700. We subtract $2,700. That gives us $25,500 per year. Okay. Well, earlier we said that the gross debt service ratio equation will give us the maximum payments, which it will. So these are the maximum payments. The present value of the maximum payments will be the maximum loan. But when we find the present value of the payments, things have to match still. How are payments being made in this loan? Well, the question says monthly. We've got yearly payments here, so those aren't going to work. So we have to change these into monthly payments. So we'll divide by 12. Payments are monthly, so we take our annual maximum payment, $25,500, divide by 12, gives us $2,125 per month. Okay. And that's the max. So that's our maximum payment. So to find the maximum loan, we take the present value of these payments at the interest rate over the time frame, 25 years, and the present value of those payments is the maximum loan. So it's the present value calculation. So let's do that next. Well, we're going to do a present value calculation. Let's start with the interest rate, as we're accustomed to. The interest rate given in the question is J12 equals 4.75%, and that's monthly, and that matches our monthly payments, so there's no interest rate conversion needed. 4.75 is the interest rate per year. It's J12, so 12 is our periods per year. It's a 25-year loan, 12 periods per year, so 300 N. Our payments, of course, which we've already found, $2,125 is our payment. Zero future value, of course, because these payments will fully pay off this loan after 25 years. And the last thing we do is calculate a present value. So present value about $372,000. So this is the maximum loan based on the gross debt service ratio. Now that is lower than the loan to value ratio maximum of $444,000. So we look at $444,000, we look at $372,000, we choose the lower of the two. So this is the maximum and most constraining test, so this is what we'll use. So this answers the question that we asked. How much can somebody borrow? You can borrow $372,000, so we're finished. Now in terms of sort of practicality, perhaps a more interesting question, or an equally interesting question about how much money they can borrow is this. Well, if they can borrow $372,000, and let's say the property actually is listed for $550,000, $555,000, that means they still need about $182,000 by way of down payment. So I think the more interesting question in many ways is, can this person buy the property? What's the more interesting question to you? How much they can borrow, or can they buy the property? We want the property sold, they want the property sold, you want the business, the mortgage broker wants the business, the person wants the house, and so on. So we want to make this happen. So the reality here is that this person would still need about $182,000 in down payment. They add that to the mortgage funds, and they could purchase the property if we assumed it was also selling for $555,000. So if they had $182,000 for down payment, terrific. You buy the house, everything's good. But what if they don't? Now, if they don't have enough down payment, do they just go away? They disappear? Well, what are their options? Well, there's a few options. First option, of course, is just go to mom and dad, great grandpa, and try and borrow some money from your family. That's probably the most common way to get more down payment. Certainly for first-time home buyers, the amount of intergenerational wealth transfer to buy housing, particularly for first-time home buyers, is in the hundreds of millions of dollars. It's enormous. So that's the first option. But let's say this person doesn't have that option. They've got some more practical options. If additional loan funds are needed, what could they do? Well, there's a few things they could do. First thing they can do is just shop around for a better interest rate. Call a mortgage broker, find a better rate. Let's say they contacted a mortgage broker or they called some lenders and they could find a better rate, a lower interest rate. Well, what if they had a rate of 3.75% instead of 4.75%. So 4.75 was the posted rate. Nobody pays that. You always go to negotiate, right? Get a lower rate. Now what's the maximum loan? Well, if we use this new interest rate, calculated a new present value, the present value is now $413,000. So what that means is we could borrow another $40,000. So the down payment is reduced to about $141,000. So just by shopping around, finding cheaper money, which is what we did, we were able to borrow about $40,000 more. We dropped the amount of down payment we would need, about $141,000. Easy. Well, suppose they didn't have $141,000 either. What could they do? Well, they can think about the mortgage terms, and they can say, well, what if we extended the amortization period to 30 years? What if we could do that? Well, if we could do that, what effect would that have on how much we could borrow? So now let's look at the relationship between extending the amortization period and the present value, which is the amount we could borrow. Let's say we extended the amortization period to 30 years in addition to getting this lower interest rate. Now the maximum loan is $458,000. That means we can borrow $86,000 more, which means our down payment is reduced to about $96,000. So just by manipulating the mortgage terms a little bit, we can borrow lots more money. We only need $96,000 now. So an easy way to borrow more, be able to purchase a house. Now, of course, with extending the amortization period, you're paying for a longer period of time as well. It's not just simply cheaper money the way the interest rate drop was. So we need $96,000 for down payment. If they don't have that, what are the other options? Well, there's one option we haven't talked about yet. One other option might be to get a second mortgage. We've only talked about a first mortgage. Well, could this person qualify for a second mortgage loan? Well, if they can qualify for a second mortgage loan, let's look at how much they could qualify for. So to do that, let's look at what's involved in qualifying for a second mortgage loan. Then we'll do a different example, and we'll calculate how much somebody can borrow for a first mortgage loan, and then a second mortgage loan, and we'll compare the numbers and see what happens. So that's what we'll do next. So let's look at a second mortgage loan. Let's look at qualifying for a second mortgage loan, and we'll see how that works. So if a borrower wants to qualify for a second mortgage loan, they've got to go through a test. The test that's used is the total debt service ratio. And the total debt service ratio is a ratio just like the gross debt service ratio was. The equation looks like this. The total debt service ratio is equal to the payments being made on the first mortgage loan, plus the payments being made on the second mortgage loan, plus heat, plus property taxes, plus any other loans, all divided by gross income. So in principle, it's the same as the gross debt service ratio. It's a ratio of money going out to purchase real property relative to money coming in, your gross income, to buy real property. So the principle of the ratio is the same. This has more terms in it because it assumes that in order to qualify or figure out what the maximum second mortgage payment would be, you're already making your first mortgage payment, so that has to show up there. And so the total debt service ratio is really trying to get a greater picture of your indebtedness or your ability to pay, or your ability to qualify for a mortgage loan. Now, unlike the gross debt service ratio, which was about 32%, the total debt service ratio is higher. It's about 40%. So that's saying a greater percentage of your income now has to be available to make all these other payments associated with owning real property, in particular, making your second mortgage payment. So that higher total debt service ratio means it's becoming harder to qualify. So the banks aren't willing to loan as much for a second mortgage loan as they would a first. And that probably makes some sense in terms of risk. Okay. So what we want to find with this equation is we want to find the maximum second mortgage payment. Because all the other terms we know, we already know what the maximum first mortgage payment is. We already know what the heat and taxes or other loans might be. We know what the gross income is. So we want to change this equation so we have the payments on the second mortgage loan on one side of the equal sign, everything else on the other. So simply rewrite this equation like this. And I've simplified it a little bit. So the payments you're making on your second mortgage loan are equal to the total debt service ratio times gross income minus the payments you're already making on your first mortgage loan, which are the annual payments, minus your annual property taxes. The maximum second mortgage loan will equal the present value of the maximum second mortgage loan payment, just like it was for the first mortgage loan. Nothing different.